But a bit about Aorus. Let me just give a bit of a background on the founding principles of who we are and how the firm was developed. So Aorus was founded in 2017 with three core principles in mind that we think can help sort of elaborate success of the fund and help design the strategy in a way where we think we can continue that success over the long term. So first and foremost, we're an independent firm. So we're entirely staff owned. We're entirely aligned as well. So we're all invested in the fund. Secondly, it's a single strategy business as well. So we only run one single fund. That's the Aorus International Fund. And we don't have any plans to launch any second or third fund at any point in time as well. So when we get into work every single day, all we focus on is just running the one fund, and therefore we can do the best as we can at it.
Actually, those are two interesting points, alignment and focus, where the very large managers can have challenges in achieving that because you're so big, you can't necessarily give everybody the same level of alignment to the, P&L of the firm or whatever. And also you tend to have multiple products and therefore multiple foci all over the place. So I think that's one of the benefits of the smaller to mid-sized firms is that they can give more attention and be more successful in those elements. So tell us about the size of the firm and the length of the track record that you've got.
And I might just touch back on a few of those points that you raised as well, because they're good points, and I might elaborate on them. But there's two pathways a fund manager can take when they're at the onset of the business. One's the profitability route, and one is the performance enhancement route. So we've taken that performance enhancement route. There's actually another principle which I didn't mention as well, which is capacity constrained as well. So we've capped our capacity at $5 billion. Therefore, it'll keep the integrity of our investable universe as an all-cap manager intact versus, continually going up the spectrum of market caps into just the large stuff and compromising your opportunity set. And we find a lot of value in the small to mid-size as well. So we want to be able to remain nimble enough to go into those. So if that means sort of hamstringing your profitability beyond a certain point, but not being able to grow to, a behemoth $50 billion, then so be it. But we hope that's the best way to manage the money for our investors and give them the returns that they deserve.
So where are you at in size now?
Yeah, good question. So we're a team of 13 staff. We've got 6 investment personnel, all based here in Sydney. We're currently managing about $2.1 billion, which has grown quite considerably in about 7.5 years.
Okay, so Mark, capping out at 5. See, like Amazon, when it says only 16 left to sell, you can put on your website 2.9 billion to go. Get in fast.
Yeah, get in while it's hot.
Get in while it's hot. So, and the track record is quite strong over the history. I think it was 2018. Is that correct?
Yeah, so Steve Arnold, who's the CIO and founder, he's actually been running this strategy for a bit over 15 years.
Yeah.
And he's got over 30 years of international investing experience. So everything he's learned over those 30 years, he put into a strategy at another firm about 15 years ago. And then 7.5 years ago, he launched Aorus. And then after running it as an IMA only for quite some time, in March 2018, we launched the first official unit trust, which is what we base our sort of track record off today.
Yeah.
And today, after 90 months exactly of performance track record, or 7.5 years, we've done 16.1% per annum returns after fees, which has beat the benchmark by about 3 to 3.5% per annum as well.
Nothing to sneeze at. So from you've maintained a very consistent style for a very long time, as you've just described. And as I understand it, or I know, it sort of focuses on quality and value. So, looking at the stocks that you own today, what are some of the common characteristics across, most of those stocks that reflect that?
Yeah, good question. And yeah, we definitely do focus on quality. In fact, we actually call our little moniker when referring to our style as quality first value investing. So we very much focus on quality first, and then we look at the valuations. We don't care what price a business is trading at until it gets to the point where it might be included into the portfolio. But some of those characteristics would first and foremost be, it has to be an established business. So one of our businesses is nearly 170 years old. It's Sherwin-Williams, one of the world's largest paint businesses. So if you think about all the market cycles that business has seen through all those periods of time, multiple world wars, multiple pandemics, and it's still here, it's still a market leader, it's still taking share. So established businesses that have competitive advantages, they grow faster than their peers, They've got a strong balance sheet, so they're growing fast. They can invest back into themselves at high rates, and they've got minimal debt on the balance sheet. And then the final characteristic would be trading at an attractive value, which we have across the portfolio. And as of today, we think it's trading probably a little bit above 20% discount to what we think it's worth. So essentially, you're buying, 15 of the world's highest quality businesses for roughly 78, 79 cents on the dollar.
And can you name sort of 2 or 3 stocks so your competitors
Yeah,
can go and
so
buy them for
I
you?
can. So
push up the
there's
price?
probably 4 that out of the 15, we capped at 15, minimum of 10.
Yeah.
There's probably 4 that everyone would
Familiar.
recognize.
Yeah.
And then there's an 11 that you've probably heard of, some obscure way, or you
Yeah.
haven't heard it before. So the ones you have heard of would be Microsoft, Visa, Accenture, and maybe L'Oreal, obviously L'Oreal as well.
Yeah.
Then the lesser known ones might be a Compass Group, a Relics, a Sherwin-Williams, which I mentioned before, a Halma, which is the randomest and most niche business in the world. They do the little sensors on elevators. So the reason the elevators don't squeeze you to death when you put your hand in there to open them at the last second, that's because Halma has 40% market share of those businesses. So
Been a few horror movies where those things have gone wrong.
yeah, it could definitely go wrong, but thankfully Halma is good at what they do, and
Okay, let's get close to wrapping it up. In terms of downside protection, you've had pretty good statistics as well. So maybe talk a little bit about that, and then just to follow up from your answer to that, talk about how your portfolio fits into clients' portfolios more generally.
Yeah, 2 good questions. I think first of all, on the downside protection piece, we actually ran some analysis probably about 2 weeks ago, actually, looking at all probably the 5 or 6 most recent large drawdowns, including April, all the way back to COVID, and then some others in between as well. And broadly speaking, across the board, we do have stronger downside protection versus our benchmark, which is the MSCI All Country Accumulation ex-Australia benchmark. And then in the subsequent 6-month recovery, we actually turned back on quite faster. So we actually outpaced the market in the subsequent 6 months as well, which is a strong sign on the downside, but then also a strong sign on the growth in the upside as well. I think because of those quality characteristics, the lack of cyclicality that we tend to avoid, so we carve out certain industries, banks, financials, mining, telcos, utility, biotech, pharma, large, narrow tech businesses. So you're getting rid of all the sort of low quality businesses, the cyclical businesses, resources as well in that as well. That might have stronger downturns. There might be over leveraged businesses, like businesses that have minimal debt on the balance sheet. So generally speaking, they hold up well. Then you've got the other competitive advantages. They're market leaders. They're also providing mission critical products or services. Most of them are services to B2B as well. So they're servicing other businesses. So it's a lot stickier. It's not uncommon for a lot of our businesses to have in excess of 97% retention rates with their clients. And I'm sure if anyone here in the room could keep their clients for over 25 years, or with a 97% retention rate, they'd be pretty happy with themselves as well. So I think those characteristics help it.
And how do advisors use you in their portfolios?
Yeah, good question. A variety of different ways. I think if they're looking to get access to a high quality active funds management team with access to the team in Australia, that's one way they could use us. So just blending us in with other managers, with genuine diversification away from the high growth managers, like a Hyperion or a Munro, or the deep value managers like an IFP or a PM Capital or something. We can sort of slot in between. Additionally, if you're looking at the constituents of our businesses and what they're trading at market cap wise versus the index. So if you look at like a Qual, which is the quality index, and a QSML, we sort of sit smack bang in between. So that's sort of more of a recent one, especially with all the concentration in the index right now. Like Qual has, I think, 300 holdings, but its top 10 weigh nearly 40%. So people are trying to get diversification away from those risks into something that's active, where we can recycle capital and maintain that strong discount to fair value across the board. The markets aren't one behemoth. They're not moving in one thing. They're made up of multiple businesses, all run by humans, and within that, active teams can find the good ones.
Fantastic. Thanks so much for that and for explaining all of it to us. Congratulations, not just a one-time winner, but a 2-time winner.
Thanks, Rob. Thanks, IMAP as well.